that, but my point I was trying to get to was what? Oh, we need to figure out what your excess capital is. So if you think about this is how much I'm getting, this is how much is going to tax. These are things that I already planned, and I want to buy a new home for X dollars and X climate. So if we take all those things off, how much money do you have? And then we run it against how much money do you need, and you'll be able to determine that there's some excess capital. And then you can make some decisions as far as estate planning or gifting, be it to charity or to children or grandchildren, pay tuition, there's all kinds of choices. But I also would agree that if you're below the 10 million number that you're allowed, you don't have to worry about rushing to do any of that. But if you're above that amount, we encourage people to utilize some of their exemptions sooner than later, because hopefully the plan is that there'll be appreciation over a number of years and it'll just keep growing and your taxes will increase. I think it's usually palatable to people to at least consider doing the $14,000 a year that you can give to each individual, and that doesn't even reduce your lifetime exemption. So typically clients are very comfortable doing at least that as a gift. And then if you are thinking about charitable gifting and you are comfortable that you have any excess, I would advise you maybe to do that in the same year as the transaction, so that'll reduce your income tax as well. And there are some strategies on that. Actually, I'm kind of skipping ahead here. The next page, some of the strategies that you can utilize, I have here is the wealth transfer that we just talked about, the $14,000 a year. Per person, and you have or you could have your lifetime exemption amount that you can use or choose not to use yet if you don't need to. There's also, I was thinking though of a charitable strategy that if you know that you want to give to charity a certain chunk of money, but you don't really know yet where you want it to go, you can put it in a donor advised fund, or there's other charitable, a little more complicated charitable trusts that you can create, and you can then actually make the gifts to the various charities over a number of years. So you have flexibility to wait and decide who exactly you're going to give it to. But you'll get the deduction this year when you have a higher income.
Okay, if you gift $14,000 to an individual, or over 14, who pays the tax on that? If you exceed that, would that be the individual who gets it, or the person that gives it?
The person that receives the gift is not taxed at all. And if you exceed that $14,000, it would just come off of the lifetime exemption amount, which is the $5,450,000.
Okay.
So you have to file a gift tax return if you exceed the $14,000 in a year and tell them how much did you go
really?
over.
Who even does that? How many people do that? Almost nobody.
Many people do it.
They do?
But who would know about that?
Wink,
Many
wink.
of my clients do it.
Okay.
Because I
Yours
talked
and
to many-
Owens. Yours and Owens are the only two. No, only joking.
Well, when you talk them into doing really substantial size gifts,
Okay.
you really need to.
She lives in
You always
Minnesota,
need
not
to.
New Jersey.
And if you're thinking about a strategy that you can use that doesn't even require using any exemption, and it's a win-win in my mind, and that you don't ever utilize your exemption, even if it doesn't turn out the way you wanted it to, you didn't use any exemption, so it's a zero-sum game. And it's called a grantor retained annuity trust, and you can take a stock that you think is for sure going to go up in value or highly likely to go up in value, and all that transfers is the amount that exceeds the AFR rate, which is 2.2 right now, I think. So any appreciation above that could pass to your children, and you wouldn't use any gift
Okay.
exemption with that one.
Can you give us a list of those stocks that are highly likely to go up?
That's my part.
But isn't that true that they could potentially, I mean, it's maybe too late now, but could they give is there a certain part of holdback or the investment into a grad at a discounted value? And then let that appreciate, and then that appreciation passes on to their heir tax-free, doesn't use the lifetime exemption.
The only thing with that might be is typically when we've done those strategies, it's an asset that's easy to value. Not that it probably has to be, but I don't know how easy it is to value CAPNA, the 20% that's still out there.
It's valued, right?
Yeah, so it'd be
It is
current value.
valued today, but if we wait 2 more years, 3 more years, how do you get the valuation each year without paying to have valuation work done?
And I think I don't know if we do it next year, but I know we will the second year.
Oh, okay. So, then it could work. Most people don't like to use illiquid assets like that don't have a market value because of doing the valuation work.
Okay.
And I think I'll just end with an example on the page that's this estimated disposition. There's
Page 11.
the balance sheet first.
Yep.
There's a balance sheet first, and this is someone I've worked with for over 20 years. Was a business owner, sold significant business, and we started doing planning the year that he sold the business. But this is his balance sheet today, and the point to make off of this is,
Want to be adopted?
okay, it's on the next page. Go to the estate disposition. But basically, he's still worth plenty of money and has plenty of money for himself and his wife. But starting in 1998, when he sold the business, we set up irrevocable trust for his children. And we put, it wasn't a huge amount we put in them. I want to say a couple $100,000 each. And this is actually a second marriage. So there's son-in-laws and daughter-in-laws that they decided that they would give to equally originally. Oh, actually not equally, it looks like. So we did that, and then we also did a grandchildren trust, and that trust was is $536,000 today. All the values were lower in the year we gave it the first time, and in 2012 was the year when they talked about lowering the lifetime exclusion amount. And so a lot of planning was done before the end of that year because people feared that they wouldn't be able to do it later. So in 2012, we did it, but we did it in a very safe way. And you all might want to think about this if you're interested in using some exemption. We did what we call actually I think he mentioned it, a spousal slat, he said, the slat trust. You basically are giving it where your spouse can still get access to the assets in that trust. So it's your right pocket and your left pocket, hopefully, if you have a good marriage. So that usually gives people more comfort to go ahead and have that happen. And then we did, he had a home in Minnesota and a home in a state that's a warm climate. We did 2 different strategies there, but we put the homes in, one in a CUPER, Qualified Personal Residence Trust, and Then the other one we put actually in an LLC agreement. But with those, you give away, they have to, in the Cubert, he has to survive the term of the Cubert, but over that time, it transfers value every year. And, at the end of the Cubert, it passes to the children. But you do it at a very discounted price of using some of your exemption. The LLC one, same kind of thing, by you putting it in the LLC, you get a discount on the valuation, because it's a limited, position that they have, not one person can't control it. But they have survived the term on the Cubert, and the LLC has, though those assets are now owned by the children, and they now give more money to their children through paying rent to them for those homes, which in this fact pattern, he has more than enough money and works out perfect. He also had a family foundation that was funded early on with over $1 million, and we've used actually almost all of that at this point. And at the end of last year, he decided that he's gonna actually close that foundation and just give away the remaining amount in there, because none of the kids have actually taken much interest in trying to get involved in the foundation or coming up with any ideas for gifts to speak of. And it does have some administrative cost every year that you have to take care of, paying for a tax return and things like that he felt was unnecessary at this stage. So basically, we took $12 million in total, $12.7 million, and got it out of his estate. And at this time, he still has $12 million that is taxable for his estate. So one piece of that is his IRA, and an IRA is heavily taxed because you pay estate tax and income tax on it at your death. So if you want to give anything, you want to give your IRA. So he decided to give the IRA you want to give it to charity, not to family. And so he had that go into the charity column right away, and then he had a specific bequest to some dear friends that needed some help. He has additional funds going to the Grandchildren Trust. And like I said, we do this schedule every year, and he looks at it, and kind of looks at where the numbers are for the kids. And last year, it's based on the percentage of the total estate, and we actually went in and reduced these numbers to different percents based upon his review of where we were at this stage, and he thought they were gonna get too much using the old percents that were in his document.
Did I understand you correctly that you said the IRAs are not exempt from the probate process? They can't be? There's no way of protecting them from probate?
My point about the IRA is that it go through.
It goes to, you can't, so basically then if you had money in an IRA, you want to gift something, and you have excess money, you'd gift from your IRA first maybe?
The IRA is what you want to use for charity.
Okay.
Because the IRA is subject to estate tax as well as income
Right.
tax. So if you're gonna give anything to charity, you use the IRA asset. And the other thing that'll happen, assuming you live a longer life, is you'll start having to take required
Right.
minimum distributions. And you can also give those, you can give 100,000 to charity with the R&Ds. And you're getting 100 cents on the dollar by doing it that way, instead of just writing a check and getting whatever your marginal tax rate is.
Julie, on the estate tax and the IRA, that's only if you exceed the 10.9 million?
Right.
Okay.
And-
For a couple, right.
For federal.
And then assume that's a traditional IRA as opposed to a Roth?
it's a traditional IRA.
Yeah, versus a Roth IRA where, because
So your Roth IRA,
you tax going in and you're not tax coming out.
right, not income tax.
Right,
I think he was also asking about estate.
right. No, I got that.
Would a 401K be treated the same as an IRA?
Typically, your 401K after you retire typically rolls into an IRA. People typically do that partly so they can do the, gifting of their part of their R&D. Yeah.
The question with whether it's 401Ks or IRAs, if they have a designated beneficiary, it almost never goes through probate. If there's a designated beneficiary, I designate my spouse, I designate somebody, and as long as there's a designation, just like life
Okay.
insurance, unless I've left it to my estate, then it goes through probate. But barring that, it won't go through probate.
Thank you.